this funny circle thing. Basically, I'm not sure if people can see it, the further out you are is the more money you're spending. And so we've got the March quarter and the June quarter, and you can see where are we? The June quarter is basically in red. But essentially what's happening is you're spending a lot on the left-hand side. So I'll just read out if you can't see who's on the left-hand side. Paying off debt, utilities, medical expenses, transport, groceries, saving. What's on the right-hand side? Major household goods, eating out, charitable donations, personal goods, home improvements, use of credit. So what I see here is a consumer who will spend when they have to, but won't spend if they have any choice in it. And so that, I think, is a really important dynamic, and we see no change in that behaviour. So our credit cards, everyone talks about credit card debt. Our credit cards are going backwards, all right, in terms of the actual amount out there, and they're paying us off. Right, which the banks sort of don't like. All righty. Housing bubbles. I'll try and reassure you. Start off with some numbers. So 12 months to July, you've got something like 20% growth in Sydney, or 17. You've got about 11 in Melbourne, and then you sort of move away to not much. So it's Sydney, Melbourne. The other thing is 12 months to data can basically has 12 months worth of data in it. So I'm sort of looking at the closer data. So I look at the last 6 months and I annualise it. And on the right-hand side there, you see some pretty impressive increases in terms of what Sydney's now doing, something like 25% in the last 6 months. Melbourne's doing close enough to 15. What is it? It's the investors, basically. In Sydney, more than 50% of all housing finance, or in New South Wales, is for investors. And it's a very similar story in Victoria, but there's more foreign money, and I'll talk a little bit about that in a minute. However, this is really specific to a couple of states. So let me assume everyone in the room is a really bad investor. Let's assume you bought at the peak of whatever city you were in, and you've sold today. How much money did you make? On an $800,000 home in Sydney, you've made $200 and something thousand. Melbourne, you've made about $80,000. The rest, you basically haven't made any money. You've made losses. And in Perth, you still made a bit of money, but it's going backwards. It's currently going backwards at about 4 or about 7%. So this is very specific. It's very difficult, basically, for using interest rates in this sort of environment, and hence that's why APRA's been involved in trying to slow investor housing in some of these cities. So a graph on the left-hand side that's important. What we're trying to do is get supply. 3 things matter in housing: supply, demand, interest rates, and do you have a job? So the left-hand side is an attempt to say supply, demand. So what we've done is look at the number of approvals vis-a-vis the population, and then we've used a 30-year average. And so the line in the middle there that's got a ratio of 1 just says you're building the same number of houses as the population needed. And all I've done here is just put Melbourne or Victoria and New South Wales in, and they're around about 0.8. In other words, they're underbuilt. So that's really encouraging in the sense that you haven't overbuilt. You have overbuilt in Perth, and you're basically neutral in Adelaide as well. The other thing that we hear a lot of talk about foreign buyers in the existing market. No one has any data. We don't have any data because they're not using banks. But we go out and we've started to survey about 300 real estate agents, funds managers, developers, etc. And what the graph on the right-hand side says, if you look at Melbourne, which is in red, so we've got apartments and we've got houses, what it says is in the June quarter, 16% of the existing flow of existing houses were to foreign people. Now, I don't know whether that's right or not. It's a lot more than what I thought it would be. The other issue you then get is Sydney's got around about 10% and not much else anywhere else. So there is this dynamic that says it's investor housing in Sydney, plus some foreigners. Melbourne, it's investor housing plus a lot of foreigners. And they're not really overbuilding in housing. So that's sort of a story that says it's not too bad. The other thing we use internally, and this is a chart that I'll just explain because it's a bit hard to see, and what is it? We think of someone's ability to borrow. So think of going to the internet these days and plugging in your income and say, can I afford this, etc. So I can use an algorithm that goes back to 1983. And I look at the ability to borrow vis-a-vis the home loan price for each of the states. And when it goes way up, it means house prices are going faster than the ability to borrow. So where are we today? Well, where we are today is actually below where we were in 1983. A lot of that is basically interest rates. But if I increase rates by 1.5% or 2%, which is our forecast, in a couple of years' time, we're back to normal. So again, this is saying that you can explain what's happened. If people geared up a lot like they used to, which APRA won't let you do, but if they did, you could see significant increases in house prices going forward. So this is not a debt-fueled bubble, put bluntly, is sort of the bottom line. And roughly we can explain what's happened across Australia. So I'm not talking about individual postcodes, I'm talking about big picture stuff. So the blue is the model and the orange sort of colour is the actuals. So over 20 to 30 years' time, we can roughly explain what we thought was going to happen. If you look at the model back here in 2012, it said house prices should have gone faster and earlier. And then it's sort of saying that house prices have now gone beyond it, but they're going to start to slow. So that's very much big picture story. This is why banks now look at postcodes. All right? These are house prices. Now, if you're in the west, you pick which one you want. So Port Hedland, Karratha. And then you look over in Queensland. And if you were particularly unhappy or unfortunate in your timing, you took out a home loan and you had 80% LVR, you could be in deep trouble at present. And so that's what banks are looking at. We are looking at postcodes. If we want to try and crash our models to say what would you need to have an Australian-wide 20 to 30% fall in house prices, you need unemployment somewhere above 8.5%. Okay? So where are we today? We're 6.25%. So if the economy gets hit by something, then you get a problem. But this is postcode stuff. But the fact that we could sort of have this data up and can show you publicly sort of says there's a lot of focus internally. So now the other thing I probably should say is house prices generally, think Melbourne, think Sydney, and to some extent Brisbane, generates really high wealth effects. So Australians, if your house price goes up, you're more inclined to spend than basically most other places in the world. So the Australian, what we call the elasticity from wealth, housing wealth, to consumer spend is 3 times higher than it is in the US. So if house prices go down, that flows straight through, and that's part of the story about Western Australia, South Australia. Now, so it does help a little bit, but what really helps is if you actually went out and built new stuff. And where we're seeing a very different story is basically the apartment market. Now, remember I told you before about the population to the approval rates, and we were 0.8 in housing? This is what it looks like in apartments. I don't know whether you can see the line there that's going through the roof. That's called Melbourne apartments. All right, 3 to 1. So if we're just looking at the population, we're building 3 times as many apartments as you need from the population based on 30 years of experience. You've also got slightly higher numbers in New South Wales as well, so they're around about 1.5. And another way you can see the same thing is the graph on the right-hand side here. The blue is the number of approvals that go through housing, through the local council. So blue is housing, red is apartments. For the last 30 years, 4 to 1. Today it's 1 for 1. Same sort of story. Now, you can argue about what's driving it. You can get very uptight about, you know, the overbuild, except is it correct just to look at the local population? And the answer is it's not. So if you look here in terms of the right-hand side, the Victorian apartments market, these are new. How many of them are foreign? And again, we've been running this for about 4 or 5 years. This says in Melbourne around about 1 in 3. What you also know in Melbourne is there's a hell of a lot of them in the CBD. Now, we've got no idea how many people are there. I've sort of said carefully up the top there, the big 4 banks, basically we can't explain 70% of the apartment towers in the CBD. They're not ours. Either we're doing something wrong or someone else is doing something wrong. What would scare us and what we worry about is what happens if the Chinese sell. But the Chinese are buying these properties not to get a yield. They're buying it as a bolt hole. So what sort of happens here, and I've got some time series on the left-hand side, and Melbourne's the black line that shoots up every now and again. You get 20%, maybe at times 30%. So it's basically what happens in the short term is you might have just fired 50,000 miners, but you've employed 30,000 roughly in constructing. So in the short term, it's actually helping to offset the actual imbalances in the labour market. And people will say, well, maybe these are not viable. My answer is, well, if they're sitting there for 30 years, 20% of them probably won't turn the lights on. And that's a medium-term problem. But in the short term, it is helping the adjustment that we've actually seen then. So that's a dynamic that we sort of look at. It does actually add to the economy in terms of short term. They are going to be built. They're being built. And the banks don't know who's funding them. We know it's cash or it's Asian money.